Hi everyone. Before we dive in, let me ask you a question that an interviewer actually asked in my private equity interview. If you suddenly receive rupees 2 lakh, would you use it to pay off your debt or not? How would you decide? Drop your first thoughts in the comments as we go. I'll tell you more about my approach at the end, so stick around. Welcome back to my channel. Today we are going through 6 classic finance interview questions arranged in increasing order of difficulty. As you watch, you will also see a lot of mini questions sprinkled throughout the video. Make sure to note them and drop your answers in the comments too. So let's start. Let's start with a classic accounting interview question. If you could only pick one financial statement to evaluate a company, which one it would be? Most people say the cash flow statement because cash is king, and that's not wrong. If I'm forced to pick, I would still choose the cash flow statement. It shows how accounting profit turns into real cash, whether the business self funds or burns cash, and whether it can service debt. Cash is hard to fake, and cash flow ultimately drives the value. But focusing on just one statement can be misleading because each statement tells a different part of the story. Let's look at three examples that show why you need the full picture from all the three. First, high growth SaaS company. This company might have negative cash flow by design initially because it invested heavily. The income statement could show 70% plus gross margins, which are steadily improving, a key sign of scalability you would miss if you only looked at cash flow. Second, a retail or grocery chains. They might have thin income margins, but the cash flow statement shines because customer pay immediately while suppliers get paid later. Just seeing earnings alone would miss this strong cash engine. Third, capital intensive airline or utilities. They might show strong EBITDA on the income statement. The cash flow statement reveals heavy capital expenditures, and the balance sheet shows major leverage and lease obligation. Only relying on the balance sheet would miss operational cash flow and profitability trends, hiding signs of financial strain. That's why relying on any single statement doesn't give the whole picture. To truly understand a company, you need to analyze all three financial statements over time to understand profit, liquidity, and position together. If asked in an interview, a strong answer is if I had to pick one, it's cash flow statement because it highlights liquidity and earnings quality. But in practice, I always analyze all three financial statements over multiple years to see how profits, assets, and cash flow tie together. This next question is just an extension of the previous question, how a company report positive net income but still go bankrupt. It sounds impossible, but it happens all the time. And here is the core idea. Profit is not equal to cash. Net income, like our income statement, is accrual based. Watch part 1 of this series to know more about it. It records sales when earned and spreads costs such as depreciation over time on the income statement. It ignores principal debt repayments. You can show a great net income line while your cash account is shrinking. Take Cafe Coffee Day as an example. In FY 2019, CCD reported a positive net income of over 100 crore on paper. But by that time, the company was carrying more than 7,000 crore debt, facing severe cash flow crunch. The classic case of net income not translating to cash flow. Meaning positive net income does not guarantee liquidity. A company can go bankrupt if cash inflows lag or obligations spike, ballooning receivables, heavy capital expenditures, or debt repayments. That's why you can't just focus on a single statement to see the real financial picture. Now it's your turn. Comment below what's your favorite real world example of a company that looked profitable but ran out of cash. Third question, can working capital be negative? And this question was asked to me in my investment banking interview. Let's see how to answer this. The short answer is yes. Working capital is current assets minus current liabilities. And current assets, you know, cash, inventory, receivables, what you own in the short term. And current liabilities are like payables, salaries, taxes, short term loans, what you owe within a year. So when liabilities exceed assets, working capital can go negative, meaning you owe more than you hold. But this isn't always a sign of trouble. In fact, many strong companies, FMCG giants like Unilever, P&G, operate with a negative working capital. They collect cash from customers immediately but pay suppliers later, creating a negative working capital position intentionally. And this free float means they run a very efficient cash cycle with high bargaining power, essentially using supplier credit as interest free source of working capital. It allows them to fund operations, invest in growth, or earn returns on that cash before payment is due, reducing their need of bank financing and lowering cost. On the other hand, if business sells on credit but needs to pay suppliers upfront, it signals stress, and in that case company might struggle to cover short term obligations. So yes, negative working capital is very much possible but can mean either powerful cash cycle efficiency or desperate liquidity stress. The difference comes down to the business model and operating cash flow. All right, we have covered the accounting and financial statement questions. Now let's shift gears into core corporate finance concepts, starting with the time value of money. And if these interview questions breakdowns are helping you get ready for interviews, hit like and subscribe. A classic corporate finance question: would you rather have 10,000 today or 10,000 a year from now? Time value of money says a dollar today is more than a dollar tomorrow. Why? Because a dollar today can be invested to earn a return on it. Let's say 10,000 today and you deposit it to bank with 5% FD would be 10,500 in 1 year. Second reason, to avoid inflation risk, because buying power of 10,000 in 1 year would be lower than the buying power of 10,000 today due to rising inflation. This question is generally asked as a trick question simply to check if the candidate understands the time value of money. Another way the interviewer asks this question is, at what discount rate would you accept 10,000 in 1 year versus 10,000 today? Tell me in the comments how would you answer this question. Next question, why is cash excluded from enterprise value? Again, this question is asked by interviewer to check if you know the concepts in depth, not just the formula. But let's start with the formula. Enterprise value is equal to equity value plus debt and minority plus preferred stock minus cash. So why subtract cash? First reason, cash is non-operating asset. Enterprise value reflects the value of a company's core operation. Business that generates revenue, serve customers, and incurs cost. But cash just sits on the balance sheet and does not produce operating profit. We remove it to isolate the value of actual business. Second, because a buyer gets the cash anyway. If you buy 100% of a company, you get cash excess on day one. You can use it to pay down debt, reinvest or return capital. So why pay for it separately? You wouldn't, right? You are buying the business net of the cash you are inheriting. So I don't have a very good example, but let's say you bought a car of 10,000 rupees, but in the car there was a bag with 2,000 in it. So ultimately when you bought a car, you bought it for 8,000, right? So it's kind of the same. Third, because EV is used in valuation multiples tied to operations. So this EBITDA is operation related. This revenue is only operation related. So we want something EV, which is in the numerator, something which shows the operating performance. So including cash would distort this multiples, especially for cash rich companies with weak operating margins. Enterprise value tells you what it costs to acquire the business itself. Cash reduces that cost because it's effectively the money you are getting back. This question comes up all the time in interviews. Don't just say cash is non-operating, explain what that means. Tie it back to the acquisition logic, valuation multiples for a complete answer. Now, a follow-up question would be, a company raises 300 million as new equity. What happens to its equity value and enterprise value? So the company issues 300 million in new shares. That means equity value goes up. So for simplification, just focus on this formula. I know this is not complete because it is missing the other part, like for example preferred stock, minority interest, lease obligations, etc. But let's just focus on the simple EV formula for solving this question. So equity, when you raise 300 million, equity value goes up by 300 million. And given that you are holding it as cash, so your cash increases by 300 million too. So this is 300 million which is increasing, this is 300 million. So net net EV, because cash is in the negative side, EV stays the same. And it should, right? Because the business operations remain unchanged. You are not using cash for anything, right? So that's why EV stays the same. Now quick quiz for you. Comment A, B or C. A for increases, B for decreases, C for unchanged. For these two questions, company issues 300 million in equity and uses the cash to repay debt immediately. Scenario 3, company issues 300 million in equity and uses the cash to buy a business or new operating assets. Comment down your answers and let's see if you understand this concept or not. And that's a wrap on our 6 finance interview questions from accounting basics to corporate finance. Earlier, I asked you a question. Check my pinned comment below to see how I answered it and watch for a full breakdown in my next video. Please also answer the other questions I have asked throughout the video. Your comments help me see how you are thinking and they help everyone else learn too. If you found this helpful, hit like and subscribe and share. It really motivates me to keep creating content like this. Thank you.